Assalamu alaikum. Have a good day. Welcome to Financial Management eLearning. We are going to discuss the cost accounting. We are in cost accumulation domain is the part 2. So it is the part 2 of module 14. We are in cost accumulation system domain. Last video, that was part 1 of module 14, we discussed objective of cost accumulation, periodic versus perpetual, and now we are going to discuss cost accumulation actual versus standard, periodic and perpetual cost accounting system, and the factorial layer. So we have seen here the cost accumulation is a collection of cost data in an organized manner. So cost accumulation, actual versus standard. So collection of actual cost in an organized way by means of actual cost accounting system. There are two primary approach of cost accumulation: job order cost and process costing. Under a job order system, the three basic elements of manufacturing cost, direct material, direct labor, and factory overhead are accumulated according to the assigned job number. And under the process costing, manufacturing costs are accumulated according to the processing department or cost center. And a standard cost accumulation, this will present the method used to accrue cost of the cost as predetermined. So a standard cost accumulation represent methods use a accrued cost as predetermined. There are two types: job costing and process costing. This method depends on the types of the production, and a standard costing is a product costing system when a company measures all costs, direct materials, direct labor, and factory overhead using standard quantities and costs. It is often used to measure performance, determine target cost, and improve production process. Now, periodic and perpetual cost accounting system. So, periodic verification is otherwise known as a periodic cost accumulation system or periodic cost accounting system. It is the system of records maintained by the controlling departments with not reflected the physical movement of stock and their current balance. So is calculating periodically. And perpetual, that means regularly. Verification of otherwise known as the perpetual cost accounting system. It is a system of records maintaining by the controlling department which reflect the physical movement of a stock and their current balance. Perpetual system is the better system than periodic. There are 5 types of a special journal in here: sales journal, cash receipt journal, purchase journal, cash payment journal, payroll journal. And 5 types of subsidiary ledger are accounts receivable subledger, accounts payable subledger, fixed asset subledger, project cost ledger, and factory overhead subledger. If you see here in the look here is the periodic inventory system. Periodic, that means record purchase of inventory. And then it goes to, if item sold, then record inventory only. And end of the period, compute cost of goods sold periodically. That we have to counting and physically after that all account for in the period end. But perpetual inventory purchase, record purchase of inventory, and then if item sold, then record inventory and compute cost of goods sold. And the period end, there is no journal entry. Okay, so this is the basic difference between perpetual and periodic. What would be the journal? For the periodic, purchase of material, the purchase accounts payable. Perpetual is inventory, debit, accounts payable. Look here, periodic is purchase, but perpetual is inventory. Sale of goods, accounts receivable in debit in periodic system, and sale is credit. And perpetual is the same way, accounts receivable, debit, sell credit. In the periodic, there is another no entry but perpetual. One entry is here, cost of goods sold debit and inventory credit. But at the year end, periodically, ending inventory after counting is debit, cost of goods sold debit, and purchase net credit, beginning inventory balance credit. But in the perpetual system, in the year end, no journal entry. So inventory valuation method, that means here, if we see that one thing, periodic system, that means a relief often an occasional physical count in the inventory to determine the ending inventory balance and the cost of goods sold. But perpetual system gives continuous track of inventory balances. And now the factory ledger, group of accounts used to record factory related transaction and to keep track of various manufacturing costs such as direct materials, direct labor, the factory overhead costs. It is a record kept by the factory. So within the factory record, factory ledger, this means the main ledgers are only 5 accounts maintaining the factory ledger. They are the general ledger, material, factory payroll, factory overhead applied and control, work in progress and finished goods. Also have the general ledger. So factory ledger is a cluster of accounts containing the production cost of a business. These accounts typically include the direct material expense, direct labor expense, factory overhead expense. We see here costing ledger, here as principal ledger or cost ledger, subsidy ledger. Here subsidy ledger as store ledger, work in progress ledger, finished goods ledger, and principal ledger or cost ledger is general ledger, adjustment account, control account of subsidy ledger. That are the store ledger, work in progress, finished goods, wages, factory, office overhead, selling, distribution overhead control, cost accounting, and overhead suspension, etc. These accounts may contain the bulk of expensive transaction generated by the business, and so are a particular interest on the part of accounting and the financial analyst who is examining the financial performance of a firm. Partly journal entry for the factory ledger. If you see here, look, purchase of material, basic entry is material debit, accounts payable credit. In factory ledger, it would be material debit, general ledger credit. Factory ledger debit, accounts payable credit. Okay, so material return to the supplier is the reverse of first entry. Look here, accounts payable debit, material credit. And the material issued to the production, factory overhead control account debit, work in progress debit, and material credit. This is the basic journal entry. But in factory ledger, what we will pass the ledger, the factory overhead control account debit, work in progress debit, material credit, and general ledger, no entries here. So a material return from factory is the totally reverse journal entry. And recording for payroll, payroll debit, deduction credit, accrued payroll credit. It is the basic journal entry. Factory ledger is the factory payroll debit, general journal credit. In the general journal, payroll debit, factory ledger debit. This payroll is selling and administration, but factory is direct and indirect of factory cost here. So factory ledger debit, payroll credit in the general ledger, deduction credit, accrued payroll credit. So this way all journal is put in here. Now we are going to solve few problems here. Look here, as the cost accumulation of Yasmin company begins operation 1st July 2020. Information of job cost sheet that There are 5 jobs. Manufacturing cost assigned in the July, job number 100, July cost assigned 12,000, August 8,800, September nil. And same way, job 101, July 7,800, August 9,700, and September 12,000. Job 102, July 5,000, another 2 months nil. Job 103, here August and September is occurring the cost, and 4 also same way. So job 102 was completed July, was completed August, and job 101 and 103 were completed September. Each job was sold 60% above its cost in the month of the following completion. Compute the balance in work in progress inventory at the end of July. Balance of inventory, that means work in progress inventory, that means July job 100 number and job 101, it is the work in progress. Because look here, job 100 is completed August. So in the month of July, it is within the work in progress. Okay. And 101 on 3 were completed September. So in the month of, for example, July, so only 101 1,800. So 31st July, the work in progress inventory would be 19,000. So 19,800. Now B, compute the balance of finished goods inventory and the end of September. So at the end of September, balance of finished good would be 47,300, because job 101, it would be finished goods balance, because here, look here, each job is sold in the cost of the month of following month. So here, job 101 and 103 at the finished goods inventory till September 13. Okay, now 3, compute the gross profit for August. Job number 102, sales 8,000, cost of goods sold 5,000, gross profit 3,000. 5,000 is the cost, and 160% would be the sale price, that means 8,000. So gross profit 3,000. I think it's okay for you. So there are a lot of questions with solution here included with this sheet, and go to my Google Drive and download it. Problem, material overhead cost of goods sold, we will find out from here. So Muttikin Limited applies manufacturing overhead to job using a predetermined overhead rate based on direct labor cost. The information would be taken from the cost record of the company for the year ended, and direct material used in production 1,250, and total manufacturing cost charged to the production 6,050, manufacturing overhead applied 2,800, selling admin expense 1,000. And the inventory for the direct material for the January 130 and the 31st December 80, work in progress January is 250, and the closing that 31st December 400, and finished goods January 300, December 200. So compute the cost of a direct material purchase during the year. So direct material purchase during the year, have to calculate it. So cost of raw material used in production as per the question 1,250, decrease the raw material inventory during the period. Look here, 130 and December 80. So difference is 50. So cost of raw material purchased during the year 1,200. Clear to you? Okay. Now 2, the predetermined overhead rate that used during the past year. So manufacturing cost 6,050 as given in the question, 6,050, this one. Let's direct material used in production 1,250, and manufacturing overhead applied 280. So direct labor cost incurred 2,000. Okay. Then predetermined overhead rate, manufacturing overhead cost 2,800 divided by direct labor cost 2,000. So 140% of direct labor cost is the predetermined overhead rate. Cost of goods manufacturing for manufacture for the year. Total manufacturing cost 6,050. Add work in progress inventory 1st January and less work in progress inventory 31st December 400. Then we will get cost of goods manufactured 5,900. Number 4, cost of goods sold for the last year. So finished goods inventory 1st January 300 as per the question, and add cost of goods manufactured 5,900. Calculate here. And the cost of goods available for sale, then 6,200. And the finished goods inventory, closing inventory 200. If we minus it, then we'll get cost of goods sold is 6,000. So I think it's clear to you. So there are few questions with solution. Upload my Google Drive, download it, and prepare yourself for your next exam. It would be helpful for you for passing the cost accounting. So here have to calculate the cost sheet. I think it is very much easier to you. Look here, all answer with this sheet. I think it's okay. Today we concluding the cost accumulation system through this part 2. So in both part 1 and 2, we discuss objective of cost accumulation periodic versus perpetual, cost accumulation actual versus standard, periodic and perpetual cost accounting system, and the factory ledger. And we solve few problems within this sheet. And I have included a lot of questions with solution with this sheet. Go to my Google Drive and download it. Okay? So it's all for today. We'll meet with you, inshallah, again with my next module job order costing system. So till then, take care. Allah Hafiz.